The global financial system rarely signals stress in obvious ways. It doesn't come with alarms or headlines most people can immediately understand. Instead, pressure builds quietly within technical systems like the repo market, an overnight lending network where banks and institutions borrow cash against U.S. Treasury securities to keep daily operations running. By late 2025 and into 2026, a pattern of subtle but important warning signs has begun to emerge. These include rising usage of the Federal Reserve's standing repo facility, unexplained spikes in overnight funding rates, an early halt to quantitative tightening, and the quiet removal of borrowing limits on emergency lending tools. Individually, these actions can be explained as routine liquidity management, but together, they suggest a system operating with less margin for error than it publicly admits. At the center of this system is trust, specifically, the willingness of financial institutions to lend to each other overnight. In the repo market, that trust is instantly reflected in borrowing costs. When confidence weakens, rates can spike within hours, and liquidity can disappear just as quickly. This is not just theoretical. The United States experienced similar stress in 2019, when overnight funding markets seized, and again in 2020 during the pandemic, when massive central bank intervention was required to stabilize liquidity. Today's conditions are different but more constrained. Higher debt levels, increased treasury issuance, persistent inflation, and geopolitical pressures affecting global energy markets. Unlike previous crises, the Federal Reserve is not aggressively expanding liquidity. It is preparing for potential stress by strengthening its backstop tools. The repo market plays a central role in modern finance. It supports treasury market liquidity, bank funding, and credit flow throughout the economy. When repo conditions tighten, the effects ripple outward, raising borrowing costs, reducing lending capacity, and increasing volatility across markets. Recent developments show a sequence of pressure points rather than a single crisis event. Spikes in borrowing from the Fed's repo facility, rising SOFR rates, and policy adjustments all point toward tightening liquidity conditions. While the system is still functioning, it is operating closer to its limits, requiring more active management from the central bank. Experts are divided on how to interpret these signals. Some view them as early warnings of structural stress, pointing to reduced liquidity buffers and increased dependence on short-term funding. Others argue that the system is simply adapting to a new monetary environment where central bank tools are being used as intended and volatility is a normal part of transition. Both perspectives rely on the same data but differ in interpretation. What they agree on, however, is that the system has become more sensitive, less tolerant of disruptions, even if not fundamentally unstable. The real-world impact of repo market stress extends far beyond financial institutions. Changes in overnight funding conditions influence mortgage rates, business loans, credit availability, and even global dollar liquidity. When funding costs rise, banks tighten lending, businesses delay investment, and households face higher borrowing expenses. At the same time, treasury market stability can be affected, influencing government borrowing costs and global financial conditions. These effects don't require a crisis to become visible, only sustained pressure within the system. Looking ahead, several key indicators will determine the direction of the system. Continued usage of the Fed's repo facility outside typical periods would suggest structural liquidity demand. Persistent elevation in SOFR above policy rates would signal deeper funding stress. Treasury market absorption capacity and bank reserve levels will also play critical roles. For now, there is no evidence of systemic failure, but there is clear evidence of a system operating with tighter margins, higher sensitivity, and greater reliance on central bank support. Two possible paths lie ahead. In one, liquidity stabilizes as markets adjust and pressures ease, keeping central bank tools in the background. In the other, overlapping shocks, such as inflation, geopolitical tensions, or heavy debt issuance, intensify funding stress, requiring more frequent intervention. Neither scenario implies immediate collapse, but both highlight a financial system entering a more delicate phase. The key takeaway is simple but significant. The global financial system doesn't begin with stock markets or headlines. It begins in overnight funding markets like repo. These systems quietly determine whether money flows smoothly or becomes constrained. Right now, those signals are active. The system is still functioning, but it is no longer operating with the same level of comfort. It is being managed in real time, And what happens next will depend on whether liquidity conditions stabilize or continue tightening at the margins where modern finance truly operates.